Hey everybody, welcome to your week in review for the week of Monday, January 2nd, 2023. And oh, what a New Year's it was. Welcome to 2023. We were off on Monday. Bond market was closed, so on Tuesday, everything got back to action. European bond markets rallied Monday, and again in the overnight session, reports are showing the European inflation is moderating. This resulted in euro gains. Treasuries weren't in the office to follow along yesterday, but they did open stronger today. UMBS were up 42 basis points early, and the 10-year was down 9. Investors are still reeling from a spell of wonky predictions. They're expecting a volatile year in trading. Fed policy will dictate how stocks and bonds perform. Some traders are already seeking out opportunities resulting from risk assets getting sold off. Recession concerns are continuing to linger as investors ponder whether Fed tightening will push the U.S. into a hard or soft landing. Spoiler alert, it's going to be a hard landing. All eyes are on the jobs report this week as softening in the labor market remains the Fed's focus. Given that Jerome Powell's focus has been the surprisingly strong jobs report, I could see a situation where bad news is good news, as in a weak report could trigger a rally in stocks and bonds, as it would increase the chances that the Fed will pivot to a tighter monetary policy to a more neutral one. Jerome Powell discussed three basic inputs of inflation. First, there are supply chain issues which manifested themselves early on in the pandemic. Second, there is housing, which had the biggest impact since the beginning of 2022. Finally, there is services excluding housing, which basically means service sector wage growth. The supply chain issues have largely been fixed. Housing will probably fade by summer. And final component, services excluding housing, is the focus of the Fed, which means that any negative news in the labor market will be perceived as positive for the markets. That big chunk there comes from Brett Niatre of the Daily Tear Sheet, who is looking for a job. So if you need a capital markets person, he'd be a good person to do it. Manufacturing exhibited the fastest decline since May of 2020, according to S&P Global Purchasing Managers Index. Sinking demand for inputs and greater availability of materials at suppliers led to a further easing of inflationary pressures, which is good. In fact, the rate of input price inflation fell below the series trend. Same price hikes also eased, albeit still rising steeply. We also got a recession warning from IMF head Kristalina Georgiev, who expects 1/3 of the world's economy to go into recession. Oil is currently at about $80 a barrel, which is low because of low China demand. That will change if and when they reopen. One major source of trade flows was a hefty slate of new corporate bond inflows. Normally, a headwind like this pushes rates higher. The same is true for a large block trade that hit around 10:30 a.m. Eastern Time. While both of these headwinds exerted some expected forces, bonds nonetheless scratched out some moderate gains, ending the day up 28 basis points on the UMBS and down 8 on the Treasury. So we went back down into that narrowing range, which is bordered by the 100-day moving average on the top, and that is the 50-day moving average on the bottom. So it's a very narrow range that we're bouncing between. It looks like we touched both of them today. But bigger and more important than even that is about setting your goals. It's a new year, so if you're one of the people who uses the new year to set your plans, get started with your goals. Get started with your goals on that, because next week we're going to have a special series of posts starting at our sponsor at WellThatMakesSense.com with the best framework I have ever seen for being able to set up a series of meetings and plans and goals and check-ins and milestones in order to achieve your goals in 2023. On Wednesday, overnight bonds moved gradually lower as volume was starting to come back. Lower French inflation kicked off a rally in Europe on the heels of German improvement yesterday. Also, U.S. futures advanced with stocks as positive reports from China and data from Europe boosted risk appetite, with inflation peaking at 9.1% in June and sliding since. A recession is now the number one economic concern going into 2023. Of course, A, the experts have been talking about a recession for over a year, and B, recessions lead to lower rates. When businesses make less money due to lower consumer spending triggered by dwindling reserves, price pressures, and aggressive Fed, companies lay off workers and more people are hesitant to spend. Weak expectations or prior overinvesting also factor in the equation, with many firms feeling that large swaths of the economy could or already have experiencing worsening macro forces and a series of unknown variables, things like war, pandemic, energy prices, etc. There are also signs that the three big world economies US, the EU, and China are also slowing down simultaneously. Even countries that are not necessarily in recession, it would feel like a recession for hundreds of millions of people, but the argument against a major recession is strong. Gross domestic product is not negative. Many haven't cut their profit forecast. Hiring remains surprisingly robust, and the unemployment rate is sitting near historical lows at 3.7%. If that resilience holds up and inflation continues to cool down, a soft landing could be in the making. I doubt it. The Fed also won't hike interest rates to the moon and has begun to set the foot off of the accelerator already, which could mean that somewhat of a slowdown is in store, but not one that slams on the brakes on the economy. And the rise of real income is likely to be a stronger force in 2023, along with supply chains being normal. That big chunk comes from robchrisman.com. The manufacturing economy did contract in December. According to the ISM Manufacturing Index, the index came in at 48.4, the lowest since the early days of the pandemic. If the index comes in above 50, it's expanding, while below, it's contracting. The prices index fell to 39.4, which is good news for inflation. Job openings were more or less unchanged in November, according to the JOLTS job openings report. The quits rate, which tends to be a predictive wage increases, ticked up as well. We also got Fed minutes. A few of the more important bullet points from the Fed minutes are: Fed minutes participants welcomed inflation drops in October, November, but concerned it would take substantially more evidence of progress to be confident in sustained downward path. Also, no participants anticipated that rate cuts would be appropriate in 2023, which is kind of abnormal. This was the most forceful language that we've heard regarding "Are we there yet?" song and dance, with respect to how good inflation reports it takes to change the narrative. Even Powell himself had previously said 2 consecutive reports opens the conversation, but that's not necessarily at odds with the minutes here, but it's definitely a takeaway for the markets to be sure. On the topic of no cuts in 2023, the market disagrees, but this would be par for the course as far as the Fed's communications have been concerned. I think the Fed still thinks that they're going to make a soft landing. I don't. At the end of the day, we are up 19 basis points, ending at 100.8, which puts us right above that Fibonacci 50% retracement line at 100.758, and we have a real convergence of all kinds of lines here. So we have overhead support at 101.02, then we have floors at 100.607, 100.172, and then 99.845. So that should provide a little more stability, hopefully. We also got a great post from our friends at econ70.com. This is the Bowtie Economist. During 2022, the Dow slipped 8.8% and the S&P 500 index fell 19.4%, while the Nasdaq tumbled 33.1%. Among the 11 sectors in the S&P 500, energy gained a stunning 59% in 2022. No other sectors rose. Although some came close, utilities only fell 1%. Consumer staples like soup eased 3%, healthcare dropped 4%, and industrial shed 7%. The other 6 sectors fell over 10%, led by communications down 40%. And then on Thursday, we got some more of the numbers that really matter. UMBS were down 41 basis points on the open. The big bad actor in the morning was a stronger ADP employment report. Remember, this report was just reformulated, so I think they're having a little trouble getting a sync on how this is done. Traders continue to wait for evidence of increased slack in the labor markets, and the data continues to point in the opposite direction. ADP employment came in at 235,000 on a forecast of 150,000, so way better. 127,000 last time around. Small to medium-sized businesses added 200,000 jobs, while large ones shed 150,000. It also showed that wage gains were 7.3% for job stayers and 15.2% for job changers, both up slightly. So we're still getting wage gain according to this report, which helps people buy more stuff and keep that inflation going. Jobless claims came in at 204,000 on a 224,000 forecast. It was 223,000 last time. There have been a lot of corrections lately, so we'll see how that plays out with next week's number, but that is a pretty big beat. Trade gap came in at negative 61.5 billion versus a 73 billion forecast, so that helped things out in the economy. But we don't really want things to help the economy, we want things that help inflation. Pricing in the market still shows that investors continue to bet that the Fed will start cutting rates before the end of the year. Yes, there is some data pointing at slowing economic activity in the U.S., but the jobs market, which is closely watched by the Fed, remains surprisingly tight. Markets still digesting Fed minutes from Wednesday. They show that the Fed focused on wage growth, which we got wage growth today. They needed to go down, which we didn't get today, even though they previously did everything possible to strengthen them by doing a lot of economic stimulus. So yeah, you're kind of unwinding the problem you created. And Fed members are making things worse by saying dumb things. Apartment List also reported that rents fell 0.6% in December, now up only 3.8% year over year, which should help the inflation number a little bit, though it is a lagging indicator. Fed futures are now reflecting a much stronger belief that the Fed will keep raising rates until it hits 5% in May rather than stopping at 4.75 in March as was previously expected. This shift will put some pressure on mortgage rates, not necessarily driving them up much higher from here, but reducing the chances to see them drop down to the lows of mid-December. At the end of the day, we were down 23 basis points at 100.56, which puts us right underneath that 100-day moving average with very narrow consolidating ranges. So everything is really tight right in that range, which frankly I could deal with some normalcy and just setting a baseline for a while. We began 2023 with some huge news from one of the largest lenders in America, if not the world. Rocket Pro TPO Vice President Austin Nemec, hope I pronounced that right, was promoted to Chief Revenue Officer, one of my favorite titles out there. Mike Fawaz is stepping up to lead Rocket Pro TPO as Executive Vice President. Rocket Pro TPO also released a Purchase Plus program, which is a credit program that offers up to $7,500 in lender credits for first-time home buyers in underserved communities. There's a very short list of communities, but check with your Rocket Pro TPO rep if you want some more information on that. They're also giving some pricing credit on 30-year fixed conventional purchases of $200,000 or less. UWM also notified brokers that they have a special program where they can buy credit reports for $37.35. Very interesting number right there. Housing inventory is rising more rapidly and costlier. The home for high-end housing inventory is up from 2 months back in February to 6 months in November. For median priced homes, inventory is up from 1 month to 4. For affordable housing, it has risen from 1 to 2.5. For the very low priced housing, it's increased from 1 to 2 months. It may be a buyer's market for the high priced housing soon. Not from econ70.com. I'm the Bowtie Economist. On Friday, the markets came out the gate with bonds being up a quarter early. It was definitely offsetting penalties on this play, but job creation and unemployment rate continued to make case for a tight labor market. Fighting for the side of good, we have slower wage growth, something the Fed has called out as specifically necessary in order to believe that the potential for true inflation correction. Non-farm payrolls came in at 223,000 on a 200,000 forecast. Like I said, ADP beat by a lot yesterday. October and November were revised down 28,000 though. But the interesting thing is when you dig deeper, is 717,000 jobs were created according to the household survey, and 679,000 of those were part-time, which is kind of leading the way for the wage growth shrinkage. That analysis came from Barry Habib over at MBS Highway. Great job there. Unemployment rate came in at 3.5 versus a 3.7 forecast. Wage growth, like we talked about, came in at 0.3 on a 0.4 forecast. Last month was also revised down to 0.4 from 0.6. So it's one of those things where it sucks. You don't want to hear about people not getting raises and wage growth shrinking, especially with all this inflation, but that's what has to happen in order to quell the inflation. The part that caught the market's attention was the change in average hourly earnings, which came in lower than expected. The street was looking for a 0.4 month-over-month increase, got 0.3. Year-over-year increase came in at 4.6 versus a 5.2 forecast. Rising wages are the biggest concern of the Fed as it's trying to avoid a wage price spiral, which is a big contributor to the 1970s inflation, amongst other things. Where would the Fed be? Where would the Fed like to see wage growth? That's harder to guess. If wage growth falls to 2%, where the Fed would like to see inflation, there's no real wage growth, so that's probably too low. The best guess would be about 3.5% or so, which would be the Goldilocks scenario. Provided that inflation falls back down to a 2% target, a big component to this would be productivity growth, which has been muted. Those last two paragraphs were from Brett Niatre over at the Daily Tear Sheet.
lots of good information always comes from him. We had some Fed speak yesterday. The Kansas City Fed President George says she sees rates reaching 5% and staying there well into 2024. St. Louis Fed President Bullard suggested 2023 might be a disinflationary year. That seems like a stretch. He added that while the policy rate is not yet in a zone that may be considered sufficiently restrictive, it is getting closer. And then today, Fed Bostic tried to tell markets that more rate hikes are coming and no rate cuts until 2024. So they're being very clear about that whole 2024 thing. ISM services came in at 49.6 on a 55 forecast, which is down a lot from last month at 56.5. New orders came in at 45.2 versus 56 previously. This is a stunningly huge miss for the data series. ISM services is highly regarded report centered on the sector that has been the focus of the Fed's attention when it comes to inflation and economic growth. But all in all, the market wasn't buying a lot of the stuff said by the Fed people. At the end of the day, we were up 67 basis points, ending up at 101.23, which puts us up in a brand new range that we really didn't spend much time in this week. It was a couple weeks ago we were up in that range where we have a ceiling at the 38% Fibonacci retracement of 101.67 and then a floor of 101.04 and tons of support underneath that. Home sellers gave concessions to buyers 41.9% of home sales in the fourth quarter, the highest share for any 3-month period in Redfin's record. According to the report from the technology-powered real estate brokerage, a record 22% of home sales in the fourth quarter included both a concession and a final sale price below the listing price. Next week, we get a bunch of data. It's going to be a volatile week. So on Wednesday, we have a roll date for the UMBS. I marked that. I think I misread that and thought it was an auction. Sorry about that. So that probably won't move the market. But on Tuesday, we have a 3-year note auction, which could move things a little bit. We have a 10-year auction on Wednesday, which can definitely play into things because that's right before Thursday, which is the big stressful day, which is the CPI number, which is a huge number that the Fed is going to be using and everybody's going to be looking at to see where inflation is. We also get a 30-year bond auction hot on the heels of that, so we'll see immediate real-time impression from the market. And then on Friday, we get 5-year and 1-year inflation outlooks as well as consumer sentiment. So over the weekend, if you have a little bit extra time and you want to learn some new stuff for the New Year's, check out our sponsors, especially WellThatMakesSense.com. Definitely a good time to sit down and make your plans for next year, or at least set your goals. And then we'll have a series starting next week from the great book Traction by Gino Wickman, who will teach you about how to turn those New Year's resolutions into New Year's plans and turn those into New Year's, we got that shit done. Look forward to talking to you next week. Have a great weekend.